Hello traders, you are welcome back to the Forex Geek channel. Have you ever placed a trade at a support or a resistance only to see price break through before reversing? Well, that is because you are not looking at the real key levels and liquidity zones that drive the market institutions. You know, it's because you're not looking at the key levels and liquidity zones that drive the market, because you need to understand that institutions do not trade like real traders. All right, they move price by targeting liquidity and reacting to supply and demand zones. So in this video I'm just going to show you how to identify these key areas so you can stop trading blind and start trading like the pros. Okay, so welcome back to the Forex Geek channel once again. And if you're serious about improving your trading, make sure to like this video and subscribe for more breakdowns of advanced trading strategies. Now, let us quickly look at how to identify key levels and liquidity zones using supply and demand trading. Let's get started, okay? First of all, we need to understand this concept of key levels and liquidity zones. You might have heard this over and over again. Maybe you are wondering, what exactly does it even mean? Well, basically, key levels and liquidity zones are areas where price is likely to react. It's as easy as that. Okay, just know that in summary, right? Key levels are areas, right? Key levels and liquidity zones, they are areas where price is likely to react due to institutional orders. Okay, due to institutional orders. So unlike traditional support and resistance lines, these are zones. They are zones. They are not a singular line. They are not a singular price point. They are called zones for a reason. They are called zones for a reason. They are zones where banks and big players place their trades, leading to major moves in the market. Right? Major moves in the market. So liquidity zones form because most traders place their stop losses and pending orders at obvious levels. So institutions take advantage of this by grabbing liquidity before moving price in the intended direction. All right. So if you notice that you have a resistance around a particular point, price got rejected 1, 2, 3 around a particular point, and then suddenly you see a breakout, and then shortly afterwards you see a reversal with a massive move, then it's possible that there were big players at work. There is a possibility that institutions were at work. Okay, because they try to grab liquidity using the orders of retail traders. All right, and at the end of the day, you'll see a massive move in the opposite direction that you were expecting, such as what happened here. So understanding this is the difference between trading with smart money and getting caught in market traps. Now, here is how you can spot these important areas on your chart. The first step is to identify strong supply and demand zones. Remember, supply zones are areas where selling pressure mounts up, right? Supply zones. While demand zones are areas where buying pressure mounts up, right? When you have buying pressure around a particular zone, right? Around a particular zone, that's a demand zone. Okay? Demand zone, supply zone. So supply zone is for the sales, demand zones are for the buys. All right, so you have to identify strong supply and demand zones. You look for areas where price made a strong move away with little or no pullback. These are zones, where buyers or sellers aggressively enter the market. So you have to mark these zones as potential key levels for future price reactions. And the second step is to look for liquidity pools. These form where many traders place stop losses. So a place where many retail traders place their stop losses, you should be cautious of those places. So if you are to enter a sell here, you might be thinking of setting your stop loss some pips above, because rejection happened here, rejection happened here. Maybe you now enter the sell here. You might just go and set your stop loss just around here. So you have to be cautious of that, because if there is an obvious place where many retail traders place their stop losses, all those big players can take advantage of that to grab liquidity. Common liquidity zones are found above recent highs, below recent lows, and near round numbers. So you have to watch for liquidity grabs, because price often wicks past these levels before reversing sharply. This is a clear sign that institutions have absorbed liquidity and are ready to move the market. Then the fourth step is to confirm with market structure. All right, if price reacts to a liquidity zone and forms a higher high or lower low, higher high in the case of upward movement, right? Lower low in the case of downward movement. So if price forms a higher high or lower low, it signals institutional involvement. So always look for strong confirmations like order blocks, fair value gaps, or displacement before entering a trade. Now, supply and demand traders don't just mark random support and resistance zones. They focus on where price will actually react based on order flow and institutional interest. Now, a supply zone forms when price drops aggressively from a level. When price drops aggressively from a level, you can see what happened here. We had a supply zone around here because of an aggressive drop showing heavy selling interest. And a demand zone forms when price rises sharply, right? When price rises sharply, showing strong buying pressure, we have a demand zone. So the key is to combine these zones with liquidity analysis to catch the best trade entries at the right moment instead of entering too early or too late. So now that you know how to identify liquidity zones and key levels, here's how to use them in your trading. The first step is to find a liquidity grab. All right, you first of all need to find a liquidity grab. You wait for price to spike into a liquidity zone, all right, and then reject it. You should look out for a spike and a rejection. Then you look for confirmation. You check if price reacts at a supply or a demand zone with a strong reversal signal. Then you enter on a retest. Instead of chasing price, you wait for a pullback to the zone. You can see what happened here. You can see this downward move. You can see this pullback. You can see this confirmation. Can you see this? Sorry about that. I mistakenly changed the chart. Okay. So can you see what happened here? Can you see this bearish confirmation candle? So this would have been a good place to enter your sell, right? So after a retest has happened, you wait for confirmation. Then you can enter your trade and set your target at the next liquidity pool. Okay, because price moves from one liquidity zone to another, so you can target the next area where orders are likely to be filled. And that is how you identify key levels and liquidity zones using supply and demand trading. Now you know how to spot real institutional levels, avoid fake breakouts, and trade with precision. If this video helped you, hit that like button, subscribe to the channel, and drop a comment below. How do you identify key levels in your trading? Let us discuss. Turn on notifications so you never miss a powerful trading breakdown. See you in the next video. Happy trading.